Welcome to another episode of the Pacific Growth Strategies Chalk Talk. In today's episode, we take a look at receivables turnover, which measures how efficiently we collect our sales made on credit. A quick note, generally speaking, credit sales are those which are invoiced for with payment expected at a later date, and this number excludes sales paid for at the time of purchase. With that said, let's take a look at receivables turnover. Okay, so receivables turnover on the chalkboard. The formula, we're going to start with our net credit sales for the period and divide that by the average accounts receivable for the period. Again, we'll take net credit sales for the period and divide by the average accounts receivable in the period to get our receivables turnover. Now in this case, our period range will be April 1st through April 30th, so 1 month. Our accounts receivable at the beginning of the period we'll find on the April 1st balance sheet, and in this case that's $130,000. Our accounts receivable at the end of period we'll find on the April 30th balance sheet, and in this case it's $170,000. Now we will need to drill down into our April 1st through April 30th income statement or profit and loss to identify our net credit sales, which in this case is $120,000. Now we have our formula and we have our components, so let's take a look at the calculation. We'll start with our $120,000 in net credit sales, and then we'll find our average accounts receivable by adding the $130,000 at the beginning of period to the $170,000 at our end of period and dividing by 2. Running down the numbers, it's $120,000 in net credit sales divided by our average accounts receivable, which is the $130,000 plus the $170,000 divided by 2, equaling $150,000. The $120,000 in net credit sales divided by $150,000 in average accounts receivable gives us a receivables turnover of 0.8. Okay, so on the chalkboard we found out that our receivables turnover in this case was 0.8. Now, what does receivables turnover tell us? Well, the higher the number, the more efficiently we convert credit sales into cash. Now, is a receivables turnover of 0.8 good or bad? Well, it depends on the industry and more specifically the business itself. For more information on how receivables turnover can impact your business and your cash flow, visit us at pacificgrowthstrategies.com and book a free discovery call. Thank you for tuning in, and as always, we wish you continued success.